People now are starving for housing. They are being challenged by extreme shortage of inventory, highest interest rates in 20 plus years, and, despite all of that, still rising home prices. People who are looking for homes, for a place to live in, are eager to hear that the home prices will surely drop in the near future, and the news sources are not disappointing them. We see an ongoing drumbeat of articles predicting upcoming housing bubble bursts, market crashes, and real estate foreclosure waves. And it is not just the press. Check YouTube. Foreclosure headlines and market crash videos are competing for your attention. As the last barrage of real estate news hit the press, all attention was on the surge in the number of foreclosures. Foreclosures in everyone's mind are linked to the last housing crash, when bad loans, delinquent borrowers, short sales, and foreclosures were the main reason for the housing market and the whole economy meltdown. Home prices dropped by as much as 40% or more in some areas, robbing people of their homes and creating new opportunities for both residents and investors. According to Atom data, there really was a significant jump in the number of homes going into foreclosure proceedings in the third quarter of this year. Nationwide, this number reached almost 125,000, lumping together default notices, scheduled auctions, and bank repossessions. It was an increase of 28% from the previous quarter and a 34% jump from a year ago. It was the highest level of foreclosure activity since the beginning of the pandemic. Are we on the brink of another housing crisis? Will history repeat itself? Let's look at the numbers. Even though the third quarter foreclosure increases are significant in relative terms, the current level of the foreclosures is staying well below the levels we experienced during the Great Recession. Keep in mind that 2020 pandemic triggered moratoriums that created an artificially low level of the foreclosure and eviction activity that lasted for years. Current increases look bigger against these suppressed levels. Will this increase in the foreclosures be enough to trigger a large enough increase in the number of homes available for sale, leading to a meaningful market adjustment or even a crash? What do you think? Put your thoughts in the comments. While in the third quarter of 2023, 125,000 homes were foreclosed nationwide, back at the top of the last crash, the foreclosure rate was hovering around 900,000 units for the whole 6 quarters. The foreclosure activity level back then was 7 times higher than now and lasted for the whole year and a half. It created a real avalanche of supply, overabundance of inventory that took years to absorb and years for the prices to recover. Here in California, the delinquency rate now stands at only half of the historic average. Only 2.2% of the homeowners are falling behind on their payments, compared to 4.2% all-time average. Know that at the peak of last recession, the delinquency rate was more than 11%. These foreclosures represent just a tiny fraction of the housing market. Only 1 in 1,007 homes in California are falling behind on their payments. Even if the current delinquencies will materialize into foreclosures and sales, it will be just a minor relief for the current shortage of inventory. At the time of this video, here in Santa Clara and San Mateo counties, there are a little over 2,100 homes offered for sale, all types: single-family homes, condos, townhomes, and even mobile homes. At the peak of the Great Recession, there were more than 12,500 homes listed for sale. Today's inventory stays at just 1/6 of the peak of summer of 2008. Another reason the Great Housing Recession won't repeat itself is that homeowners' equity is at all-time high. According to Investopedia, the average U.S. mortgage holder has $185,000 in equity. Or, if you look at the numbers differently, 50% of the mortgaged homes now have at least 50% equity. Even if these homeowners will fall on hard times, they still will be able to sell their homes at the current prices, pay off their loans, pay the selling and closing costs, and still have some money left over to take home. Very few will accept fire sale prices or walk away from their homes, like many homeowners did in 2006, 7, or 8, and allow the lenders to foreclose. And on top of that, most of the homes are financed at the low interest rates that are no longer available. 30% of outstanding mortgages in California have interest rates below 3%, and 39% of loans are between 3 and 4% rates. Altogether, almost 70% of the homeowners enjoy mortgages with interest of 4% or less, roughly half of the current interest rate. Most of these loans are 30-year fixed-rate mortgages, and their monthly payments will not be affected by future interest rate increases. It gives these homeowners additional incentives to stay put and to prioritize their house payments above all other expenses, just to keep the housing costs down, keep them manageable, even if they get laid off or run into some other financial troubles. To summarize, the market is not the same as it was leading to the last crash, and the homeowners with outstanding loans are in much stronger financial position. The housing market is characterized by chronic shortage of inventory, especially here in the Bay Area. Prices are still growing and are inching closer to a new record high. The homeowners have the highest level of equity in their homes, and most homeowners have 30-year fixed loans with very low interest rates. The situation looks stable, and we don't see any danger for the market falling off a cliff, at least in the near future. This is Michael Talis with the Talis team. With major developments happening daily, if not hourly, it is critical to monitor and report on all the latest trends in the real estate industry. This is exactly what I will be doing. If you found this video useful, subscribe to our channel, support us by clicking on the like button, and please share this video with your friends who may also benefit from it. Till next time.